episode 2 of the Forex Enlightenment series. So in the first video I made, I kind of explained what the channel was going to be all about, as well as some of the expectations you should have regarding what you'll be learning from my channel. So in order to have a structured kind of a learning system, I have a document I will be referencing part time, just to make sure that I touch on some of the key important topics or headings I need to clarify on. So from the last or the previous video I made, which was the episode 1, where I was basically introducing myself, I think some of the subheadings here have been treated, except from the what Forex is all about. So since we are in episode 2, we'll just like proceed and take it on from there. So what Forex really is and what Forex is not. So starting from the first topic, which is what Forex actually is. So as I said, during the course of this series and video, I'm going to be making reference to some of the tools we use as traders. So in as much as I just want us to have it at the back of our mind that I'm not trying to teach you Forex, but in order for me to explain to you how Forex works, I have to use some of these tools that we use as traders in trading. So yeah, what you're seeing now is a trading view interface, and basically trading view is just an application that we use to analyze the market. So trading view has both the application as well as the web version. So I just think it's necessary I explain to you guys what trading view is all about, because I'll be making use of actually 4 of these tools, from TradingView to MT5 or MT4. So MT5 and MT4. So I'm currently using MT5, so I'll be referencing MT5. You can also make use of MT4. They both share similar interface, just that MT5 is the more advanced application to MT4. And what we basically use the MT5 for is just to place our trades. So here is where we do the buying and the selling after we've done our analysis on TradingView, which is this platform you're currently seeing. So just as the next heading in the episode 2 talks about what Forex actually is. So Forex basically, starting from the misconception people have with the term Forex, the full meaning of Forex is the definition of Forex basically is the short term for the full meaning foreign exchange. And from the name, it implies the exchange of two currency pairs. That is, Forex in itself is you exchanging, buying and selling a currency pair of two countries. So, and I think it's better I also point out that me myself, I trade gold basically. I don't trade Forex actually, but because Forex is the general term people use to categorize everything, whether it is you are into trading currency pairs, or you are into trading gold, or you are into trading commodities, oils, or whatever have you. So they have this generalized, there's this general misconception that for everybody is trading Forex, which isn't actually so, because when you talk about Forex now, this is TradingView, and this will help me explain better. As you can see, all of the instruments here, and when I say instrument, I'm referring to the currency pairs you can trade, or whatever it is that you can trade, whether be it oil, commodities, gold, silver, futures, crypto, and whatever it is. So but Forex in itself is limited to the exchange of two currencies. So these currencies are currencies of countries. So as you can see here, you have Euro USD, Euro being the euro, and the US being the dollar. So you have GBP USD, GBP being the pounds, the British pounds, while the USD is the US dollar. So when you are trading Forex, when you hear Forex or you hear Forex traders, you should know that these are people that are trading currency pairs. And the term Forex it shouldn't be rightly applied to everybody that is trading. So you can be a stock trader, please just call them stock traders. You can be a future traders, you should call them future traders and not forex traders. Forex traders basically are people that trade forex, which is currency pairs. That is, they are trading the currency of two country, one being the base pair and the other being the quote. And the thing about when you trade in this pair is that wherever you are buying or whenever you are selling, you are actually doing the opposite simultaneously. And to rightly explain what I just said, so as you have euro USD here now, euro against the dollar here now, so whenever you are buying euros, you're automatically selling dollars to buy that euro, and whenever you are selling euro, you are actually buying dollar to sell that euro. So I just want to put that out there quickly. So I might be explaining some terms that might look confusing for now, but I'll just implore you to stay along. The more we delve into the video or into the series, the better you get to understand and be able to connect these dots as we proceed. So still on the issue of forex. So I hope we are all clear now that when you say a forex traders are those in particular that trade currency pairs. So if I trade, me as a gold trader now, you can call me a gold trader instead of a forex trader, because I'm not actually trading forex currency pair. I'm just trading gold. I'm a commodity trader. So you can have other traders like crypto trader here now, and if you come into the class of crypto trader, you're not going to find anything relating to forex pairs. So if I try and say maybe GBP USD here, you see GBP USD is not found in the crypto category because GBP USD is a forex pair. So let me redo this. So if I say GBP, is it GP? No, it's GBP, not GPB. So once I say GBP USD now, you can see this is British pounds against the US dollar. Just for clarification's sake, if I come to the crypto and redo the same thing and say GBP USD. So let me try and do this. Okay, this is taken from all sources, that's why it's still showing here. But then this in itself are not actually the forex pair, that is the gold against the dollar. So if you want to trade forex currency pair, that means you are a forex trader. But once you are going into trading cryptos, then crypto trading, the instrument you trade in crypto is different from what you trade in forex, and by so doing their characteristics also differ. That is, in terms of how much you could trade them, how to calculate their lot size, their gains, their volatility. So all of these matters. So we also have indices. So these are the different forms of instruments you can trade. So indices are like index, like the US 30, the Dow Jones, the Nasdaq. These are categorized as indices. You also have bonds, and you also have economy. You have options. I'm sure some people are familiar with options trader. So we also have stocks, which basically are like stocks of organizations, like you see Apple, you see Tesla, Nvidia, and whatever have you. So I think it's just right that we touch up on that and clarify what forex actually is. So a quick brief or a quick recap: forex is a short term for the full meaning foreign exchange. And in the scope of forex or foreign exchange, this is you just trading the currency pair of two countries. So and this instrument are usually paired, they are actually in pairs. So it's either you are trading GBP against USD, or the US dollar against the Japanese yen, or New Zealand dollar against the US dollars. So these instruments are usually pairs of currencies of two countries. So I think that should be enough explanation regarding forex term. So now moving on, I think we also touched a bit about the difference between the forex, crypto, and the stock, where I was trying to explain that each of these categories of instruments behave differently, so you can't use the same approach, in as much as when you are viewing each of these guys, that is when you view GBP. Let me try and view GBP USD now. So all of them still uses this candlestick chart, so the chart is the same across board, but the movement differs. How GBP USD, how the pound moves is different from how gold will move. How Euro USD move is different from how GBP JPY is going to move. So you don't expect them to have the same characteristics, because you are not trading the same thing. So they are usually their volatility actually differs with the instrument you're actually trading. So let me put it back to my default, which is gold, that I trade personally. So having said that, now let me introduce you to some of the lingos I'll be using to explain in this series, so as for you to be able to get along with me. So the list of lingos that you see here are not limited. I might be having to include more as we go on, and I'll be rightfully explaining what I mean by them, or how we use them in the industry, or in the forex industry. So pips, when I say pips is the smallest unit of movement of any given instrument. So and how do I explain this to you? So the movement of, let's say, because now this is gold now, the movement of gold, that is from this price when it was $4,153 to $4,264, the movement, the unit movement, the smallest unit movement of this instrument, which is gold, from year to year is calculated in pips. So I just want you to have that at the back of your mind. We are going to be building on that later on. So lot sizes is how much of a given instrument you want to buy. So once you are trying to place a trade, so you are going to be placing that trade along with the lot size you want to place that trade, or you want to, like, this is just basically how much of that particular instrument you are buying or you are selling. And for me to explain lot size, I need to explain I need to explain to you the foundation of how this lot size applies. So in the forex market, the smallest unit of any instrument that you can buy or sell is actually the micro amount. Then the mini is should we say the medium is actually the mini amount of that instrument, while the standard why the standard is the standard amount. That is, the smallest unit of any instrument you can buy is actually calculated in the micro amount. The medium is calculated in the mini amount, while the standard amount is calculated in standard lot sizes. So the micro lot size is 0.01 and ends at 0.09. So from 0.1 upward, anytime you are using a lot size like 0.1 up onto 0.9, then you know you are using a mini lot size. Then anytime you are using one lot size, that is one standard lot size and above, then you are using a standard lot size. So these in itself work around with how much you are going to be making or how much you are going to be losing. So how much you'll be making or how much you'll be losing in the forex market is dependent on whatever lot size you are using. So I'm going to explain further on when we get to that bridge, but I would just like you to have it at the back of your mind that this lot size is just telling you how much of the volume of that particular instrument you are trading. That is, when you are buying, how much of the volume are you buying, and when you are selling, how much of the volume you are selling. So equity in forex, because the market is actually closed now, you can see here the balance is telling you how much you actually have, Your equity is your floating profit or your floating loss together with your balance. So I didn't mean we are in an active trade now. My balance is reading 4,769, or let's say I was in an active trade buying gold now, and I was up $100. My equity is going to be reading 4,869.97 dollars. That's what my equity will be reading. So basically, your equity is your floating profit or floating loss together with your balance, and your free margin is how much you have in store to place another trade. So that's just me explaining this in the most simplest approach. So bulls and bears. So I'm sure most of if you are already, like, if you are familiar with the forex space, you already understand what bulls and bears is all about. But if this is your first time hearing about bulls and bears, so bulls and bears, basically when the market is buying, that is when the market is going up in an ascending pattern, this simply means a bull activity or a bullish market. That is, the bulls are in controls, so the people that are buying are called the bulls, while when the market is falling, the people that are actively participating at that moment are called the bears. And this term was actually coined from how a bull, when a bull is trying to attack you, it tries to sweep your feet by trying to attack you from below upward. And that's just what the naming that's brings about the name, because anytime the market is going up, is more of coming from under and going up. So that's why they call it a bullish or a bull activity. But once the market is coming down, a bear pounces on you, that is, it attacks you from above below to below. That means, like, it comes from up and goes down. So that's why they call the sellers the bears. So the sellers are bears in the market, and when the sellers are selling, they call it a bearish activities, or the market is being bearish. And when the market is buying or going up, that is, the bulls are the major participants, then they say that particular market is a bullish market. So I've talked about the bullish and the bearish market. So just to reiterate, when the market is falling, that is, example here, when the price of gold fell from 4,377.984 dollar per ounce of gold to 3,885.11. So these activities, that is, the fall of this gold up until this price, was as a result of the bearish market, that is, the bears. This is as a result of the bears being the major participant in the market as at that time. So, and also the rise of the of gold from 3,000 to 3,929.96 dollar per ounce up until 4,379.395 dollar per ounce is a result as the activity of the bulls, that is, the bullish market. So not to confuse you, I just want you to understand that when the market is going up, is as a result of the bull activities, that is, the bulls are buying. And when the market is going down, it is as a result of the bearish activities, that is, the sellers are selling. The bulls are referred to as buyers in the forex market, and the bears are referred to as sellers in the forex market. Stop loss basically is you saying, okay, if I'm buying from so point, then I want to only continue to try and buy up until when the price is on, or up until when the price gets to this level. And for me to cement what I'm trying to explain, let me just quickly use let me try and paint a scenario here. So this tool that you see me using is called a long position tool, and we use in the trading view environment to anticipate and to anticipate our profits, as well as stop loss before getting into a trade. So I'm trying to explain to us what stop loss is here, so I'll be limiting the explanation to just the stop loss scope. So this red zone, so whenever you are buying or whenever you are selling, you have to set a stop loss, because that's stop loss serve as a safety net for you to say, okay, I only want to buy so far this price hasn't gone below this level or gone above this level. So for a buy scenario now, because you want to buy, you expect the price to go up and not to come down, so your stop loss is going to be below. So this thing, that is this indicators saying stop, so this red line is saying, okay, I only want to accommodate loss up until this extent, that is I don't want the price, anytime the price is trying to go below $4,152.10, I want to be taken out of that trade. So that's what stop loss is. Stop loss is your safety net when you are buying or you are selling. So I just explained to us from a buy perspective. So from a selling perspective now, that is when you are trying to sell. So I'll be using the inverse, which is the short position. So let me place both of them side by side. This is a long position here, this is a short position. For a long position, your profit, you are going to be anticipating your profit to be ahead, that is above, because you expect price to continue to push up, and so you don't expect price to come down. So when prices is starting, like when price starts to reverse, then you also want to have a safety net that, okay, once the price has reversed below this level, you want your broker to take you out of that trade. So we are also going to talk about broker in a bit, but I'll just implore you to stay along with me right now. So yeah, this is the long 2 and this is the short 2. You use a long 2 when you are buying, and you use a short 2 when you are selling. And whether it is you are using a long 2 or a short 2, you are always going to set your stop loss. When you are buying, your stop loss is going to be below because you expect price to be going up, and when you are selling, your stop loss is going to be above because you expect price to come down and not go up. I hope I'm able to explain what stop loss means there. And yeah, this should be stop loss and take profit actually, because when you are in a trade you're anticipating that, when you're in a trade, you're anticipating that when the market why am I opening my VS code, sorry. So yeah, I said when you are selling or when you are buying, of course you want to make profits. Like, the goal is to make profits from the price fluctuation, that is from the point of view buying to when the price have dropped further. So this area is marked, this area marks your profit, your profitability, that is how much profit you want to have or you want to gain from that trade. And as you can see, you see another heading that says risk to reward. So risk to reward is just comparing how much you are willing to lose to how much you are willing to gain. So once I adjust this, you can see that the number is fluctuating, because this is telling you that for so amount of money you are willing to risk or lose in the market, your potential gain risk to reward wise, so is it either 1 to 1, or is it 1 to 2, or is it 1 to 3, or whatever have you. So most often at times they tell you that whenever you are risking 1, you should be looking to make 2. So but this channel is not about this is not me teaching you how to trade. This is just me trying to explain some things that I might need you to understand as the series progress, because I'll be making reference to them. So support and resistance from my experience, these support and resistance, like, various traders of various gurus have different terms. Some will call it supply and demand, and the basic, or like the intro definition to it, is just support and resistance. And these are just levels, that is they are levels or price ranges that you expect the market to get to and to pick support from. That is, this is talking from this is talking from an upward market direction. So a resistance is going to be a price level above the price range of the market, while a support is going to be a level below the current price of a market. So let me add style to this level here to make it more visible. So as you can see now, this level marked out by myself now are just this is a resistant level is going to be at the top of your chart. So as you can see, the goal of drawing out this resistance level is just saying that okay, once price gets to this level, because price has reacted to that level the first time, the second time, is most likely price also reacts to that level the third time and continue to fall. So if the market has been in a bullish run, then it's expected that once the market gets to that particular level, if the majority of order filled in at that level are filled by sellers, then it's likely the market is going to fall after getting to that particular level. So, and as you can see now, in this case, once the market got to this resistance level, it fell massively. So support level, as I said, are usually at the bottom. So resistance level are above. They are more of like a ceiling that the market continue to rise to, and it gets to that ceiling and it begins to fall because it faces resistance. We said once the market is rising, these are bullish activities. That is, these are bulls pushing the price higher. Then they can't always push the price higher forever and ever. There have to be a resistance at some point in time. So these resistance are marked by resistance level. And if the case is the inverse, where the prices are falling, that is when it's a bearish market or the bears are in control, the price also can't fall forever. Like, there have to be a point where the market is going to get to and is going to face some kind of a resistance from the buyers. So these levels are called support level. So this might sound confusing, but I just implore you to stay along. I'm going to I've already defined take profit here. So I'm going to explain, like, we are going to get a better understanding when we get to how to actually place a trade. So but for now, just stick with me. So leverages, I think leverages, I'll leave this last three to my next video, because I don't want to I don't want the I don't want to make the video too long because I know the attention span and some of the things I've explained earlier on too might have been too cumbersome. So I'll just let you shimmer in those points with speak on. So that is the pips, which is the smallest unit movement of any given instrument. The lot sizes, which is a function of how much of an instrument you are buying or selling. Equity, which is your floating profit or loss. And bulls and bears. So these are the two participants in the market. So the bulls are people that buys and the bears are people that sell. And when they are buying, they call it a bullish market, and when the majority are sellers, and when the market is selling, they call it bearish market. Stop loss is your safety net for when you are in an active trade. That is, when you are buying, you want to have a price range whereby once the market is starting to fall below that level, you want to exit that trade to protect your capital. Support and resistance, these are just levels in the market where the market is supposed to face some kind of whether to face some kind of resistance actually. So a resistance level is always going to be at the top, whereby the market has been rallying or going bullish for a very long time. Then it gets to that point, then it faced a resistance, then it starts to sell. Or if the market has been selling so far, it gets to that support level and bounces off of that support level before picking momentum and starts to go up. So take profit. So take profit, as we've said, take profit is just that level of that level point you expect price to get to before you cash out your profit. So that's what take profit is all about. So all of these are going to be, you are going to be understanding how they play a role in the forex or when you are trading. So but I just want you to have that at the back of your mind, like these are terms and lingos, like these are things that you just have to understand basically, so you don't have to like understand. I'm not trying to explain to them, I'm not trying to explain them explicitly and go dive. I'm not talking about them deeply. So this is just me trying to give you quick explanations regarding them, so that when I'm talking about them or using them later on in the series, you get to understand. So I'll see you in the next episode where I'll finish up on talking about leverage, time frames, and trading tools. So thank you and stay tuned for the next episode.